Let's quote Kermit the Frog as we head toward the closing bell. It's not easy being green, but all three of the indices are in the green. Let's bring in our guest, Sandy Brager, partner and managing director at Aspirant, and also Chris Konstantinos, Riverfront Investment Group. Let's start with you, Sandy. Are you surprised we're going to end the week? It looks as if we will close with the Dow, the S&P 500, and NASDAQ all up today?
Not a big surprise to me. What I'm most excited about is the run in small caps. They've had a nice week here in the U.S. and also emerging markets. Those are two areas that we're allocating a lot of money toward, especially on the value side of things. That's where we see opportunity, Adam.
Chris, where do you see opportunity right now?
Yeah, I like what Sandy's saying. If you look at small caps, you look at emerging markets or value plays in general, these are the types of plays that tend to do well when the economy is in the early stages of a reflation. And I think that's basically where in the cycle we are. So like what Sandy was saying, we actually have also been adding to some similar themes since November, not so much in small caps, but rather in value-oriented plays, both in the U.S. and internationally. Emerging markets is another place we've been adding in our longer horizon portfolios. And it's not that we've totally, forgotten about the growth theme. There are some secular growth stories that we still really like, but after having been overweight growth for quite some time, years, it's kind of nice to see value start to get a bid, because I really think that illustrates some underlying strength in the market itself and its ability to continue to make new highs.
All right, Sandy and Chris are going to give us more deep dives on their input into where the markets are headed, but let's go to Jared Blickery. We are a minute and a half out from the closing bell.
Yeah, we got a nice rally here. So let's go to the Wi-Fi Interactive. The Dow is only up marginally, but had been in the red. All three had been in the red, I believe, in the last hour. So the S&P 500 and NASDAQ each up about 0.5%. And you can see this liftoff we got here in the final hour of trading. But look at the Russell still holding on to losses for the day. Now let's take a look inside the market. Here's how the NASDAQ 100 is shaping up. And you can see money pouring into the mega caps because a lot of these names were red just an hour ago. Apple's now in the green along with Microsoft. Alphabet each up less than 0.5%, but Amazon's up exactly 0.5%, and so is Tesla. Facebook in the green as well. Well, let's take a look at the cannabis stocks as we head into the final 30 seconds of trading here. And Sundial having a little bit of a tough day along with Tilray. You can see those stocks down 12 and 10% respectively. But you take a look at the gains for the week. Lots of dark green there. And just as we head into the closing bell, we'll take one final look at the week's action in sectors. Energy up 5%, followed by tech, communication services, financials, healthcare, and industrials. All of those are outperforming. Only utilities and discretionary are in the red.
And that does it for the week here as we close out the final trading day. We have the Dow, S&P, and NASDAQ shaking out their final trade, some buying action, like Jared just noted, into the close. We have the Dow up just around 28 points, S&P up nearly 0.5%, as well as the NASDAQ. Some of that sector action that Jared was just going through in terms of the weak energy technology among the outperformers there today, leading the way, energy, financials, and materials. In terms of the Dow, why we're seeing that green on the screen at this point, Intel, JP Morgan, and Goldman, those three stocks leading the way. We want to bring back in our panel. We have Sandy and Chris here standing by. And Sandy, let me just go to you. We haven't talked about the 10-year yield yet, and that's so important. We have the 10-year yield hitting its highest level that we have seen in a year. And of course, this comes on as we get some worries about this pent-up inflationary pressures. I'm curious just to get your take on what you're expecting, what you're anticipating now.
Sean, our outlook for fixed income is on the low side. We expect maybe 1% to 2% returns at most as we look out over the next 7 to 10 years. So over the last 6 months, we've been reducing our fixed income. We haven't gotten rid of it completely. We think it's a nice buffer for volatility. And our fixed income is ranging on average between 10 and 30% of portfolios. We see a lot more opportunity in the stocks. And as I was mentioning earlier, in more of the value names, particularly in small cap, overseas, and emerging markets. We're very concerned about large cap growth. So we have some positions there, but we're worried that we might be in the ending stages of a bull market, and we'd like to protect against that. And again, that's where the fixed income helps a lot.
So I'm going to take Sandy's comment about at the end stages of a bull market. I'm going to ask you, Chris, that a lot of us as perhaps middle of the road investors, not with the insight the two of you have, look at the earnings surprises we're getting in the fourth quarter. And the companies always lower expectations and then they surprise us. But you're seeing this not just in the United States, you're seeing it in other parts of the world. So what should that tell us as regular investors?
Yeah, again, I think this goes back to the breadth question. Breadth in the US market, meaning the average or median stock, is improving, which I think is an indication of the overall health. And then breadth looking globally, meaning how many markets outside the United States are also doing well. That breadth is also doing quite well. So I think that gives us some optimism that that the cyclical bull market that we think started sometime in March or April of last year still has legs. And in fact, we track what we call earnings momentum, which is the ratio of upward revisions to downward revisions. We track that across a number of different countries and regions. Right now, it's as strong as I've ever seen it globally, which I think is, to your point, is a really good sign. And yeah, companies they like to guide us down and then they surprise the upside in the last moment. But another way to look at that analysis we do internally is we actually look at earnings beats relative to where the company was guiding 6 months prior. We actually just looked at this in an internal meeting this morning, and that is as strong as we've seen since the first quarter of 2018. So again, I think these are some clues into the overall strength of the market. We're not as concerned that we're at the precipice of a meaningful negative trend change in markets.
Sandy, if we do see that meaningful negative trend change, though, I guess, what do you expect to be the catalyst? Is there one or two things that you're specifically looking for?
Shauna, I wish I knew what the catalyst would be. That would give us more insights. It could be anything. We're really focused on valuations, and valuations of U.S. large cap stocks are just so high. We've seen market capitalizations for some of the biggest names double and triple over the last 9 months. And there have been strong earnings, but earnings aren't matching that. And so, it'll be interesting to see what happens. We're protecting ourselves, our clients. We have some fixed income. We have some liquid alternatives. We're not necessarily predicting that there will be a big fall, but if it happens, if there is some downward momentum, we want to have some protection and we want to have some dry powder to go back into equities if we see some declines, especially in those large cap U.S. stocks.
And as we say all of this, we could just crunch, for the week, you got the Dow up about 0.5%. You got the S&P 500 up 1.25%. NASDAQ's up almost 2%. So I'm going to throw this to you, Sandy. Caution, but don't take your foot off the gas yet.
No, don't take your foot off the gas. I mean, and you're mentioning the returns for the week, for the year. We're only 5 or 6 weeks into the year, the returns have been really strong. So no, we think clients should be remaining invested. A lot of clients have that we're working with have a lot of cash on hand from liquidity events that they were pushing into the end of last year with fears around maybe some rising tax rates under the Biden administration. And so we've been having a lot of questions. They're asking, is it too frothy? Should we be putting money in? And again, we do think this is a good time to be invested, but we think investors should really pay attention to where they're investing. Stay away from broad market-based investments. Look for those areas of the market that just haven't recovered as much from April of last year. And you should be on a good path in the months and years ahead.
Hey, Jared, real quick, take us home on this. You got a final thought?
Yeah, let's take a look at the charts here because it was a pretty choppy week in the Dow. We did end on a high note here, not far from the record highs we saw earlier in the week. You take a look at the NASDAQ. The NASDAQ 100, by the way, closed at a record high. The regular NASDAQ did not, but here's the NASDAQ just matching its highs from Wednesday. S&P 500, record closing high. Russell 2000 just trailing off a little bit into the end of the week. But you take a look at what it's done on a year-to-date basis, pretty nice gains. They're up 15%. And by the way, best start to February for the Dow since 1931. Now, here's a look at the 10-year T-note yield. That was in play this week, ending at the highs at 1.2%. Haven't seen that since last March. And finally, the U.S. dollar index rebounded a little bit today, but gave those gains back in the middle of the day, ending for the week on a down note. But that is supportive of the risk markets, which we've been talking about. Guys?
Thanks, Jerry. Chris, we'll wrap it up with you. What's the number one thing that you're watching as we turn our focus to next week in terms of what could really impact the markets?
Yeah, sure. And I think you brought it up, Sandy brought it up earlier, the 10-year Treasury. We think one of the single most powerful drivers of equity prices here is not only the direction of interest rates, but also the magnitude of them. I don't think that stock markets get too concerned about rising rates until you get somewhere over 2% on the 10-year, which historically speaking is still a pretty low rate. But you also have to watch the shape of the yield curve, and we're watching that very closely. We're still thinking that we're in that sort of Goldilocks period where a broad steepening of the yield curve is positive for equities. But again, if rates go too high or if they move too quickly, that could extinguish this rally we're seeing. So we are watching that pretty closely.
And Sandy, your last take on what you're watching for next week or even as we go out another month.
Adam, we are keeping an eye on valuations. We're looking at rebalancing client portfolios with the run up in equities so far this quarter. It's a good time to rebalance, make sure we're staying on track with our allocations.
Sandy Brager is a partner and managing director at Aspirient, and Chris Konstantinos is Riverfront Investment Group. We appreciate you both being with us today.